What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie, Charlie and Ben with you, unpacking the week's news. Big week again for announcements across the broking space. I feel like we say it every week, but it is just super busy at the moment.
Yep.
Ben, how's your week been?
Yeah, good. Had Monday off and then rate decision week, so it's always massive for us.
Huge week. I also had a day off this week, but not voluntarily. I accidentally poisoned myself with some chicken. So there we go.
Yes.
Note, a wellness alert for everyone. Make sure your chicken is in date. Charlie, how's your week been?
Yeah, it's been good. Like you said, a lot of headlines to follow, so looking forward to unpacking it all with our audience.
Yes. Well, of course, the big one, as Ben just mentioned there, was the rate decision for June from the Reserve Bank of Australia. The Monetary Policy Board met this week on Monday and Tuesday and as normal announced on 2:30 what the decision was. Not many surprises here, to be honest.
No.
But, of course, we were hold 4.35% for yet another month. Well, actually, another 6 weeks because we'll go into the next rate decision not until August.
Yeah.
Ben, we were talking about this earlier. Pretty much unanimous across the board. People were expecting it to hold. Did you think it was going to be any outlying activity of a hike? Any sort of, potential chance of that?
I didn't think so. And that was kind of broadly aligned with what the major banks, their economists sort of expected was going to happen. And I think that was most of the chatter in the market as well. They also really saw that June was going to be a hold and I guess where they differ is what's going to happen next after that.
Yes, absolutely. And I think a lot of this came after, what's been happening in the economy. And Charlie, you've been writing about the rate decisions over the last 6 months.
Yeah.
Obviously, we've kind of been tracking closely what all the economists are saying, what the RBA is saying, what Michelle Bullock is saying. And you weren't really surprised either. You're pretty much like, this is what everyone thought.
You kind of have an inkling sometimes of, well, maybe they might kind of have a shock move. But I didn't have any of those sentiments at all. Just because that 30-day rate tracker was forecasting 100% chance.
100%.
Yes.
Yeah.
Yeah.
For like 2 weeks before.
Yeah. So it was a long-standing kind of expectation from the market, but also the big four. They were all unified that it was going to be a June hold. But I thought the monetary statement was actually pretty interesting, and then
Actually. For once.
Yeah, for once.
conceal that opinion. But no, I think it really reflected what the banks thought it was going to say. It kind of read verbatim for what the banks thought it was going to say.
Well, they were kind of echoing what they'd said the month previous
Exactly,
anyway.
yeah.
So
But
it was all just an echo chamber.
They kind of accepted that, they acknowledged that, activity has really slowed and grinded down. And that they want to see that. They want to see the activity drop, the economy slow, inflation come down. And they've
Not
highlighted
the economy slow. They want the economy to keep going.
Well, yeah, true.
Inflation to slow.
Yeah, but they've kind of said as well, acknowledged, I should say, that it has slowed.
Yes.
They don't want it to slow,
don't want it to
but
slow,
they've
yeah.
acknowledged that it has, and they've attributed that to the 3 consecutive hikes. And they're also stating that inflation is still too high for comfort, so which is why they've kept the cash rate where it is, and that they want to be attentive to incoming data over the next 6 weeks. We've got some big incoming data kind of releases, that being that June CPI print, which is going to give an indication of this inflation situation. If it shoots up, if those secondary and third kind of round impacts have become embedded in the economy or not.
And I think this is also the thing that, as sort of Michelle Bullock said after the May decision, and she said again this week was around, it gives us time to wait and see because we have had 3 consecutive rate hikes. So February, March, May.
Yep.
Yeah.
Not April.
Yeah, I was like 6 weeks. February, March, May, and then obviously another 6 weeks. We'll have the next one in August. And I think at the end of the last rate decision in May, she was like, kind of saying we want to have some time now.
Yeah.
This gives us time, buys us time by hiking early in May.
Yeah.
It gives us time to see the impact. And of course, since then, we've supposedly had a peace deal in the Middle East.
Yeah.
Now, kind of depending on who you ask, there's a peace deal. So the details of that are still obviously kind of coming out as we report on this. But that will also potentially have some changes to what sentiment looks like, to what spending looks like, to what pricing does, to what inflation does.
I think that was having a really major drag on sentiment too. Like the longer that conflict dragged on,
still ongoing, but yes.
Yeah, but I think the more people's kind of outlook was deteriorating and in the doldrums.
But throughout all of this, And during a press conference, she mentioned it again. They've sort of been at pains to Michelle Bullock has been at pains to stress that even before that, inflation was too high for their comfort
exactly,
level.
Before the conflict started, probably in February, March. And I think this is again what she was saying this week. I keep saying this month. It was like 2 days ago, 3 days ago. She was sort of saying, well, we're not ruling anything in or out. We'll wait and see. But some of the language I thought she used was quite punchy for her. Charlie, you wrote this story on the press conference. What was she saying?
Yeah, it was really pithy quotes from Michelle Bullock's post-meeting press conference, and it was reflected in the post-meeting statement and also in the press conference. She did not rule out further tightening in monetary policy. She basically declared, look, if that's what we need to do, that's what we need to do, and we won't hesitate to do it. And she really rammed that message home, and she couldn't and wouldn't refused obviously to rule it out. I guess why would she?
Why would you? Shoot yourself on the foot.
And she said, "I'm just not ruling that out." End quote. And there were a couple of other things as well. She kind of also revealed that a hike was not debated at all. It wasn't floated and wasn't kind of considered for them as an even alternative option.
Well, so what did they talk about for 2 days?
That's the mystery, isn't it?
Just the decision to hold. Do you think we should do nothing? Yeah. Do you? Yeah. Do that 9 times around. What else do you talk about?
Yeah, it is interesting that they've seemed to sort of put that sentence into the mix as well. I suppose maybe that's just trying to say.
And she also spoke on the growing division and split among economists, both at banks and lenders, but also kind of independently as to where they think rates are headed. You've got a bit of a clear divergence of where economists think rates are heading. Some thinking there are 1 or 2 more, some thinking that it's going to remain on an extended hold for the next year. She was asked on
Michelle Bullock.
Yeah, Michelle Bullock was asked if those if either of those camps had validity, and she hosed those down and said she acknowledged that there was a split among economists, but she said, quote, "I think some are calling for cuts, but not till next year, so it's not imminent. Quote, I wouldn't be jumping on those numbers quite so firmly. I think we need to wait."
I mean, of course she's going to say that.
It's really interesting as well.
And again, the major bank forecasts are based on the forecast of the RBA, and the RBA's forecasts are based on the forecast of the major
Exactly.
banks.
It's a bit of a circle of life kind of thing.
This whole echo chamber, they're all saying the same thing, looking at each other. But of course, she's not going to say adamantly what direction they're going to go in. But I did think it was interesting that she was asked specifically about hikes, and she was like, they're not off the table.
No.
Well, obviously, if we need to, we will. And as we say, there's so much uncertainty. Who knows where we're going to go from here? But it's at least for a month, for the next 6 weeks, a little bit of stabilization, a little bit of breathing space. Because, of course, we're still at the highest interest rate we've had for, 2-3 years?
Yep. Yeah,
more,
quite a while.
Yeah.
Very much so. It's obviously those previous hikes in 25 have been completely reversed.
Yeah. So we're back now. I think 4.35 was the highest it was in 2020.
Yeah. The question if it goes, if it edges up again.
Remember what date
I know.
this was.
It's funny that we always find ourselves in a kind of new tightening cycle before we realise it's begun. So we're in a new cycle, that one's ended type of thing. But
hopefully this is ended. And as you were saying there, the forecasts are split. So it's Westpac who's really the outlier, saying 2 more hikes. Yeah. And I was surprised they didn't readjust that after Michelle Bullock's conference.
Yeah, so they're kind of the only outlier. I think the rest of the banks are sort of saying if there is going to be more tightening, it's going to be in 2027 So that's interesting too.
Yeah. So most of them now are saying, we'll think 4.35 will be the peak of this tightening cycle, and then cuts coming next year. Yeah. And then potentially hikes after that. But, obviously, that's always going to be the way. Hikes and holds and cuts.
They've put dates on that as well. CBA's dated May and August in 27. It thinks for those cuts to come in, 2 cuts, as in those 2 meetings. And ANZ has also detailed August and November. Yeah. So the second half of 27.
And I think, obviously it's really hard. No one has a crystal ball. It's really hard to know what the economy is going to do. And they always caveat and hedge by saying this is based on the current trajectory and if nothing changes. But obviously that is never the case. Stuff always changes. But I think what is interesting is seeing, we've recently seen a real deceleration in mortgage lending recently following those 3 rate hikes. The first lot of first data coming through from after the May decision.
Yeah.
You wrote an interesting story, I think it was from Equifax, talking about mortgage inquiry demand really falling off a cliff, and brokers having said that, it's the end of financial year, but weirdly activity is super low at the moment. People just are not looking for a mortgage.
Yeah, so mortgage, as you said, more overall mortgage demand is down in May, and it reversed quite considerably between this is May 26 to May 25.
Yeah.
So compared to the start of this year, which overall total mortgage demand was up 10.7%. Compare that with April, it was down 0.9, and then kind of month on month, its overall mortgage demand has now slipped to 6.6%. So that's basically 6 percentage points in a month, which is quite a considerable drop. And it's also broad-based as well. So you're seeing the first home buyer category really, as you said, deaccelerate as well. That was up 7.7% in January. Compare that with May 26 to the previous year. It's now decreased by 9.1% as well. And then also refinancing, which was lifting up a lot of that demand in mortgages, that's down as well. So it was up 16.2% in January. It's now fallen 7% in May. And switching is down, and refinancing at the same lender is also down. So it's kind of every statistic you look at, there's been a drop.
And I think that makes sense, because if you compare May 2026 to May 2025, obviously the rate environment is super different. If you compare May 2026 to January, which is what you're talking about there, or December, we hadn't gone through the rate hiking cycle. So it makes sense that the mortgage demand has fallen. But this is the main worry factor, I think, for a lot of brokers now, is being like, well, thank goodness we have a hold. Maybe some people will be more willing to come into market or make a move, because I think the real issue at the moment is just indecision. People thinking, what's happening with CGT and negative gearing? We'll talk about that in a bit. What's happening with the first home buyer guarantee caps? Like, are property prices really just sort of out of the caps now? What's happening with guarantees? There's so many sort of questions I think people are just not willing to move yet. And even for vendors, people trying to sell a house, struggling. Auction rates really low. I think last week it was like 50% didn't clear.
Yeah, you could certainly understand why a borrower would probably want to wait a couple of months and see how everything sort of pans out before making a commitment and that sort of thing.
But if you're listening to Westpac, you might not want to, because they're saying 2 more hikes. So, go talk to your broker, I guess, at the end of the day, and they can help you sort the wheat from the chaff. We'll take a quick break here. And when we come back, though, I'd like to talk about the CGT and legislative update, because we had an announcement from Anthony Albanese and Treasurer Jim Chalmers this week. And we'll get into that just after this message. So we've been talking about capital gains tax and negative gearing ever since the budget way back in April?
May.
12th of May. Yeah. And since then, the last month or so, we've been covering, obviously, what's been happening, how it's been proceeding, what people think about it. Most of the pushback has been negative that we've been covering. Very few people actually being like, yeah, I'm okay. But I think particularly when it comes to the different types of asset that this applies to, lots of questions, not necessarily about the property element, though, of course, investors are not thrilled about that, but also about what happens to all other assets that are now being encompassed in this new negative gearing and capital gains tax regime. Charlie, some announcements this week. What were they?
Yeah, massive news from the government on Thursday. We had Prime Minister Anthony Albanese and the Federal Treasurer Jim Chalmers front the media. There was speculation earlier in the week that these carve-outs and concessions would come and be released before that, imminently, basically, in the next week. And Anthony Albanese quashed that. But they did, in fact, kind of release and detail all of these carve-outs and concessions, and they are quite significant. One of the most significant was the lifting of that eligibility for small businesses to claim that 50% discount. Obviously, after those changes were announced in the budget, it was $2 million annual turnover if you're a small business to still receive that. Yeah, and a massive kind of pushback from small business groups, small businesses themselves really despairing why this was changed. So
because it's not the normal measure of SMEs. Normally we say 10 mil. So
yeah, well, now it is 10 mil.
Yeah, there we go.
It's been rolled back. This is the chief concession, basically. So the 50% active asset CGT concession has been lifted fivefold from 2 to 10 million. And this is one of those 4 concessions that was in place on that existing regime, but was the only one that was kind of amended when the budget was announced. Now it's back to its status quo. So probably a lot of small to medium-sized businesses sighing a big sigh of relief. Obviously, this tax only comes in once you've sold your business.
Yeah.
Yep.
Hold on to your business.
Yeah, that's the thing.
yeah.
If you're contemplating selling, maybe rethink that because there's...
No, because you're still getting, obviously, more value. Every time we talk about this, we're talking about the level of discount.
Yeah,
and
exactly.
it's still discount.
Exactly.
So, there's still something there.
You're still going to be taxed. It's just about how much.
How much, exactly. So I think that was pretty interesting. And that, again, comes from a lot of outcry, I think, from small businesses because, as you said, 10 million's normally the level that people sort of expect SMEs to be. So they were like, why is it only 2? And then, of course, different people saying, well, different businesses should have different requirements because some put in a huge amount of capital to get off the ground. For example, startups or fintechs, so, they put in a massive amount of money when they're developing technology.
Yeah.
It'd be different if you were kind of, I don't know, a tutor. You probably are not putting in the same amount of money into your small business at the beginning. So it kind of, they were saying maybe there should be carve-outs for different industries, which again, it seems has been listened to. Yeah,
and that carve-out now extends to high growth company and the tech sector and startups. So it's not just small to medium-sized businesses that are going to receive that discount. It's also the government putting out a new carve-out for tech and startups as well. But that's quite convoluted and there's a lot of details, real eligibility. The government's just designed a new tax break.
We could do a whole separate podcast on that. And we're not tax specialists, so we're not going to. Maybe listen to our sister titles on accounting.
I've written a story on that for Thursday, so our readers and viewers can go check that out as well. But they've extended that, as you said, to really kind of high growth, high capital sectors, which it would be a hit.
Yeah, because again, if you're trying to invest in something like AI, for example, which the government is really on about at the moment, then, maybe they would be like, well, why am I being penalised for this?
Yeah.
But it is interesting because there's been so much...
pushback.
I was going to say engagement from the broker channel, but particularly from the fintech area. And we've written about stories in the past on both The Advisor and our sister publication, Broker Daily, about the engagement brokers have been having with the opposition mostly, because it seems that they haven't really had many opportunities to talk to the government. But they have had heaps from the opposition. Obviously, the opposition very hungry to nail this coffin and be like, well, yes, we agree that this is terrible, as any opportunity they would. So we've had lots of meetings with brokers and fintechs and accountants in the SME space who had been impacted by this, who've been engaging with the opposition. I think another one takes place today, actually, here in Sydney, with some of the people who have been spearheading this. And I kind of think about Julian Fayed from Loan Options AI and Joseph Dowd at Simple Finance / Home University, both been very active in this space. So yeah, we'll have to wait and see what comes out from that.
Yep.
We're going to take a quick break here and we come back looking at what brokers think of the lenders. Lots of big news coming out from our research arm, Agile Market Intelligence, in partnership with Broker Pulse. And we'll get into that just after this. So major news from major bank, the Commonwealth Bank of Australia, Australia's largest lender, who announced on Thursday that it was disaccrediting many brokers. It didn't actually say that specifically, but it's moved to disaccredit brokers who haven't written a loan with the major bank in over 12 months, or those who typically might be disaccredited for things like breaking code of conduct or doing something they shouldn't be doing.
Yeah.
But this is obviously a major move because lots of brokers will have lenders on panel. They'll be accredited with them and kind of not necessarily use them in a year. We see this in our third-party lending report, which is our annual survey of brokers. We see the lenders they're using change. We see it in the monthly Broker Pulse survey that Agile Market Intelligence puts out. The who brokers use each month changes. So 12 months is not a massive amount of time to have had not written a loan to then find that you actually can't access the major bank anymore. Now, we haven't had exact numbers on this yet, but it's thought this could be thousands of brokers who would no longer be able to write loans with Australia's largest lender unless they obviously get reaccredited. Huge deal, particularly for brokers who might use some of their tools that CBA is really well known for. CBA is always really well known for technology. Brokers love their valuation tools, for example, and their calculators. So they won't be able to access that anymore. That would be a big drawback for a lot of brokers. I wonder, though, if it means that they'll start writing CBA loans because they'll be like, actually, I just want to use this tool. So I'll send a deal over to them. But of course, they'd have to now go through this massive reaccreditation process. So apparently they have been told previously, I think last year it was sort of a soft de-accreditation move where they were like, we are moving increasingly to focusing our investment and our work with our established broker partners. But
and it's not, I guess it's tricky, right? Because I mean, similar to like what NAB has sort of mentioned, where it's kind of shifting its focus to sort of a targeted approach to deepening relationships with like select brokers. But I mean, writing business with a certain lender, it might be reflective of what the borrower wants and how these products are sort of positioning themselves in the market. So yeah, it is really interesting.
Really interesting. And I think like the 12-month thing is kind of like, it's difficult because you're kind of forcing people to use you. If you're saying you have to write a loan in this 12 months or we'll de-accredit you and you have to go through the whole reaccreditation process, it takes time and you have to go through all, like that's a real drawback. Like if you were shopping anywhere else, if you, let's say you hadn't used Woolies for a year and then you tried to go shopping and Woolies is like, sorry, you've got to actually do another test before you can come in here. You'd be like, oh, I'll just continue shopping at Coles then.
Exactly.
Yeah, exactly.
It's pretty unheard of.
So it's kind of, it surprises me. 12 months is not a long time. But of course it makes sense from the commercial point of view. They're probably like, well, we would love people to use our tools and also write loans with us, not just use our tools and not write loans with us. But as you said there, Ben, NAB doing a very similar thing, talking about targeted broker support. They want to put more investment into brokers who do use them rather than kind of doing a broad brush broker strategy. And of course, for CBA, this makes sense because less than a third of their mortgages are now written by brokers. Now, chicken and egg, is that because brokers aren't using CBA because they don't want to? Or is that because CBA is not putting the investment into brokers? What comes first? But this is really interesting. And it brings me to the third-party lending report survey that Agile Market Intelligence conducts each year for us. And this year, as always, I think, CBA's ratings for broker support plummeted. They've always been the lowest. Well, not always, but the last probably 10 years since the Royal Commission, they've been low. But this year, really, really plummeted. So if you are interested in finding out more about the third-party lending report and how majors fared, check out the July edition of the Advisor magazine, which will be out in a few weeks because we'll be going through exactly how the majors fared and what brokers said about them. But CBA is always really well rated for technology, pretty well rated actually for its people. But where it really comes lacking is its broker support, absolutely in the doldrums at the moment. When we also think about, though, I think what else is happening at the moment, I mean, end of financial year, last few weeks, lots of busy activity, talking about, what's happening with rates, what's happening with mortgages, what's happening with commercial stuff. Charlie, you've been talking a lot about mortgage demand. Where do you think we'll be going the next few weeks?
Well, I think all the indicators are showing that it'll probably decrease just because you've had a lot of these really significant changes, shifts or announcements in quite a short amount of time. Obviously, you've got rates that have just kicked in and they're at an elevated position, but you've also got uncertainty and speculation about these tax changes, hopefully a little less so after the government's kind of position on these carve-outs and concessions have been announced, and now they're going to be writing in that new bill definition into the law. So hopefully that gives the lenders and banks more clarity as to where they can land on their investor policies moving forward. But I just think it's going to be a little bit of a recalibration over the next couple of months. But then you've also got commentators saying, well, now's probably a good time for first home buyers to enter the market as well, because you've had that investor pullback as well. Obviously, rates are quite high, but they've said that now is a window of opportunity for first home buyers as well, because there's more properties on the market for longer.
Yeah, problem is it's just expensive.
Oh, that's the thing.
Yeah.
It is now the right time
first
to really
home buyer
be
with
getting
loads of money.
Exactly.
Yeah. They'll be fine.
Yeah, but I think the position, the trajectory will be down. Just how much?
Okay, so that's mortgages. Ben, for commercial side, you write quite a bit about commercial lending for the Advisor. What do you reckon commercial lending will look like in the next few months?
Next few months, I think the big thing immediately is end of financial year. So there's always that little spike in demand. And yeah, I think from a lot of the conversations I've been having, particularly on our In Focus podcast, we're often talking to SME lenders and working capital lenders and that sort of thing. And they're sort of talking about the cash flow pressures that a lot of their clients have. But there's also things brokers can help them out with, things like debt consolidation and that kind of thing. And even things like asset finance and simple auto loans for your sort of personal borrower who might be in your book and might need help with something like that. There's always something a diversification opportunity there.
Yeah. And I think that's something that we're hearing a lot from brokers. You know, we had our new Broker Academy roadshow recently, and a lot of brokers were like, mortgage demand is really cooling. I've only just started my broking business. How am I going to pay my bills if I don't have that much business coming through the doors? And, you know, it's always hard when you're first starting anyway. You haven't got a massive database. So a lot of them were saying, oh, maybe I will look at diversifying and either referring out to another broker who does commercial loans, or referring out to a commercial lender who can help me but still provide me with commissions if I refer them to someone, or maybe I'll learn it myself and, you know, start doing a new sort of adding a new string to their bow. So I think this is something that we are seeing a lot more brokers focus on, a lot of lenders talking about it, being like, this is the time, if you haven't yet started commercial lending, to think about it. And speaking of which, because, of course, we are on the pulse of what's happening, we'll be doing a webcast at the end of this month on the final day of the financial year to look at how brokers can be diversifying into commercial finance. We'll be talking to Pepper Money about all the commercial support they provide brokers. We'll be talking to Connective as well. Brent Starrenberg, who heads up the commercial arm at Connective, about what they're doing to support brokers, plus commercial broker George Karam from BF Money, talking about how he's supporting clients with their commercial needs. So it will be a real smorgasbord and wonderful vat of facts for people looking at SME finance. Very good. Do make sure it's free. Do make sure you tune in. It's on the Advisor website, theadvisor.com.au. If you go to the webcast section, you can register for free. Tune in on the 30th of June when we talk all things commercial lending and why and how you can be diversifying. Ben, Charlie, thanks for joining me today and unpacking all the news. Any nice plans for the weekend?
I'm not sure, actually. I'm always on the spot. I think I probably sound like the saddest,
You just
saddest
don't
guy
plan for
outside of
anything.
work.
Yeah.
I think I'm seeing some friends.
Yeah.
So let's just say that.
I'm seeing friends, leave me alone. Charlie?
I think I'm going to do some socialising, which is nice. A couple of nights out on the town.
Ooh.
That'll be
on the town.
That'll
End
be
of financial
fun.
year.
Yes.
Blowing off some steam.
Yeah.
Certainly after this week.
Yeah, I'm just going to be avoiding chicken this weekend.
Yes.
I'm still slightly scarred by that.
Yeah.
But other than that, yeah, I think last week I kind of enjoyed the last of Vivid, and now it sort of really feels like winter when Vivid
I believe
has
it's
come
over.
gone. I know.
Like, that was so short. I didn't actually.
3 weeks.
I know, but like I didn't realize that they started in May. I always thought it kicked in June.
Yeah.
So I was late to the party, and then just
Yeah.
when I was contemplating it,
Gone.
it was the last day.
Yeah.
Oh well.
Oh well.
Showed how serious I was about it.
Yeah, but it was good fun. But now I feel like once that's really for me the marker of winter. Like once Vivid is finished, now it's like, what else have we got to look forward
Time
to?
to get out the Doonas.
Yeah,
the thicker
exactly.
Doonas.
I'm just watching the World Cup at the moment.
Yes.
The England game was pretty good, so that's all right. So that's powering me through. And then soon we'll have Wimbledon and the Tour de France as well.
Oh,
so
yeah.
I'm just watching Lord Sport.
Yeah.
All right, well, everyone, if you've got any news for us or seen anything you think we should be talking about or writing about, let us know. You can reach us at editor@theadvisor.com.au. And of course, leave a comment if you want us to delve into any particular areas of focus. We're here for you. We'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.